Welcome to TheoTrade. This is Don Kaufman. January 29th, 2021. Some serious sell-side activity hit the marketplace throughout the course of this week. Listen, GME may have actually triggered some of the sell-side activity in the broader marketplace. But now people, the bigger question is, will it stop? We're going to cover that and much more on this weekend's update. Let's get to work. We're actually going to start off with what I term a market damage report. The big squeeze. Well, that's now what I'm referencing. GME, AMC, BlackBerry. Again, you wouldn't have thought like in a million years that these were going to be the underlyings. That all of a sudden, if you will, be the crescendo of the marketplace. And again, I'm now referencing it's the big squeeze, the crescendo of the marketplace. If there was a sign out there, if there was a sign the marketplace was, bubbling over, hitting a top, it's when you have a stock like GME being discussed, okay, by Congress. And from there, things just went downhill. Listen, in just a few minutes, we'll have a very candid discussion regarding GME and, again, what I term the big squeeze, okay? Prior to that, though, let's get down to business. We'll talk a little bit about the market as a whole, some of the price action that we saw throughout the course of this week, and overall, again, a little bit of a damage report. One of the first places I want to start here in the S&P futures. Okay, something that you may or may not look at all that often. Again, in the S&P futures are used predominantly as a hedge for a lot of market-making firms, proprietary trading firms. Sure, people are absolutely trading them on an intraday basis, but I did want to show you that the volume started to get a bit more serious out there. You know, we did today, 2.5, 2.6 million contracts in the S&P futures. The reason I want to bring that to your attention, anytime you're in a marketplace that starts to get a little bit extreme, and again, this is a bit of a damage report, right? When a marketplace starts to get extreme, you have to look for the extreme, and that is volume. Volume, because you want to see people capitulating their guts out all over the floor. And if they are capitulating in the broader marketplace, you would see that actually represented by volume. Now, I'm not going to hesitate to say that the volume, all right, it got up there. Once you start doing more than 2 million contracts, it kind of rocking. But net, let's bring this up on a longer time frame. Ruh-roh, ruggy, okay? You ain't seen nothing yet. You got to see probably between 3 and 4 million S&P contracts trading before you really start to see fear kind of grip hold in the entire marketplace. Now, again, I need to stress to everybody, this is just one of those areas that, again, it's just not something that is often viewed in the marketplace. Like, you should be looking at S&P volume, not necessarily like, oh, it'd be huge, but hey, marquee levels, 3 million contracts before you start high-fiving everybody that this is an extreme sell-off. All right, next on the docket here, SPX. So the SPX is down about 127 points on the week. So let's cruise over to the SPX because, well, a lot happened in here. And with the SPX, one of the first things I want you to see, all right, we had about a $73 expected move. Now, that's the expected move for the entire week. So you're looking for this move of plus or minus $73. $73. Ooh, what do you got over here? Again, you got about a $127 move on the week. Not quite a 2 sigma move. And when I reference 1 sigma, 2 sigma, if you look at a distribution curve, like 1 sigma over here, well, it was plus or minus $73. 2 sigma, all right, you're going to get crazy out there. You got to have like a $150 move higher or lower. Okay. Well, we actually did kind of hit that at portions of the day here on Friday. We rebounded and very, very mildly, but net, you also have to recognize that the S&P futures, they continue to slip a little bit after the cash market closed. Those S&P futures slipped a little bit. But again, we actually smashed through, okay, the lower edge here of the expected move. And why that is important, we've actually had quite a number of weeks inside the expected move. And when you start to get, if you will, consecutive weeks outside the expected move, that's when things get a little bit more serious. Now, I'm going to cut to the chase. This next week, because you saw some pretty wicked sell-side activity the last couple of days, this next week that we're coming into, yeah, put on your big boy pants because we're going to like $132 expected move. Yeah, I'll reference that again right at the end of this video, but about $132 expected move. And boy, if we break through that one, people are not going to be happy at that point in time. But yeah, we are actually trading, 30% plus volatility in the overall S&Ps. Okay. What else do we have in terms of a damage report? One of the other things I want you to look at here with me is the year-to-date percentage. And the reason I think that this is important is people often use January to gauge the entire year. I'm just not into that. I'm not. Okay, listen. The SPX has been as high as about 4%. It gave it all back. Give it all back, literally, though, this week, and the S&Ps are basically flat on the year. But that's not all your different products out there. If you look at the QQQ is actually up as much as almost 7%, actually pulling back to 1.7%. Last but definitely not least, the IWM. The IWM, who's the big winner? The IWM has been up almost 13% at one point on a year-to-date basis. Gave about half of that back throughout the course of this week, but the IWM is the big winner. Now, another aspect, absolutely unequivocally worth noting. All index products broke expected move. For those of you, again, that follow expected move, understand expected move. What this kind of means, right, is the sell side activity. It wasn't in one area. We felt it everywhere, okay? In fact, what I'm going to talk about here, well, momentarily, that correlation was really starting to grip hold in the market. And it wasn't earlier in the week, but when you start looking at the advanced decline line here, and again, I'm being very specific here to the S&P 100, this is what I talk about with correlation and correlation coefficient. That is pretty much full-blown correlation. Once you start getting 92 to 95 stocks in the S&P 100 trading to the downside, you're correlated. What does that really amount to? Okay, first of all, you look at this and you're like, oh, good, because you're never going to get capitulation in a marketplace until you start to see correlation. So capitulation, which is everybody chucking up their proverbial guts at the exact same time, you're not going to get it until you see markets starting to correlate. So you could look at this as a positive and negative. Now, right now, which I'm going to cut to the chase here, I kind of look at this a little bit as a negative because all of your index products, if you look at, again, the IWM broke through the bottom edge of the expected move. The QQQ, okay, QQQ broke through the bottom edge of the expected move. Obviously, so did the spiders. The S&Ps broke through the bottom edge of the expected move. Okay, what got hammered the most in terms of expected move? Take a look at your financials. Okay, they're more than a hop, skip, and a jump outside the edge of the expected move. All right. Enough of that, because all I'm trying to do right now is just give you a quick feel, again, of a damage report. But what does this net out to? Damage thus far, to me, mild. It's absolutely mild. I want you to take a look again at a broader time frame, a broader chart. And again, I'm not much for being the market technician over here, but far be it for me to start to bring out some technicals here. I'll just box things out. Again, we're back to where we began the year. But hey, the way I look at it, just to get back to where we were in November, right? You got to come all the way back, okay, to 320 in terms of the spiders. Now that's 3,200 inside of the SPX, okay? That to me is where some very serious damage would be done. And if you look down below over there, you're like, are you crazy? Okay, that is 500 S&P points away. Yep. And guess what? Here's the fun part. The fun part of that story. You have $132 expected move this coming week. That's why I mentioned it. So net, and again, I want to reiterate this. The damage thus far, okay, for me, extraordinarily mild. So if you're looking at this, and I want you to actually use that to contemplate your own risk and contemplate what you're comfortable in terms of risk moving forward. Because a lot of people are like, that's it, they're going to buy the dip. I don't care about any of that. I don't. I'm not here to tell you, okay, we're heading higher, we're heading lower. I'm going to give you my opinion here in a minute with the selling, will this selling stop? I'll give you an opinion in a minute, all right? As a risk manager, I think you need to look at this and just say to yourself, yeah, this is absolutely nothing right now. Okay, we've barely even skinned our knee, and things can get serious. They can get serious in a hurry, and you will know they're serious when you're trading at 3,200 or below in a very, very short period of time. Again, We'll know more this next week. That is for sure on that kind of expected move. We are going to be a rockin'. Now, here's a little bit of the opinion piece. Will this sell-side activity stop? Volatility futures say, prepare for impact. All right, this is, again, a little bit of an opinion piece that's coming in here. So the volatility futures, for those of you that actually want to totally geek out for just a second, volatility futures, people talk about contango and backwardation. Basically, the volatility futures are inverted. They look like that, right? What that means is short duration volatility futures, the 19-day, that's your 19-day. That little monkey is trading at 32.85. You go a little further out, about 47 days out. Okay, so here's the 47-day, and that little monkey is trading at about 32.40. Okay, so we are absolutely, all right, flipped over. We're inverted, and that's why people get all confused with contango and backwardation. You go even 82 days out, you drop down to 31.50. So what this is saying, and again, I always like to quantify and qualify exactly what this is. And I said up here, they say prepare for impact because they're saying that there's more risk in the next 19 days. Like the world has a better chance of blowing up in the next 19 days than it does in the next 47 days. And that the world has a better chance of blowing up in the next 19 days than it does, for instance, 200 days from now. And that, people, that's chaos, right? The other thing, VVIX, the volatility index goes absolutely, it's in never land over here. This is so deep into the VAMA zone. The VAMA zone is anything north of 110. That's when I say duck cover, get under your desk and start rocking back and forth. So the two volatility indicators, the two major volatility indicators that I look at, okay, they go ballistic. Prepare for impact, okay, and all right, so will the selling stop? Clearly the volatility is screaming that we're on fire right now. But traders, and this one's weird, traders are not necessarily running to bonds. Okay, bonds. Okay, one thing I will point out, they got some big boy volume in them. Bonds and notes. Okay, these things were a rocket, and I'm not exactly sure what to make of this hit. I'm really not. All right, I kind of anticipated if the proverbial crap hits the fan, that they're still going to run to bonds. Okay, see, the whole thing is traders are not running to bonds, not yet anyway. I'm telling you, this next week in trade. If you start to see these bonds rallying, duck cover because we're in for it, man. That's going to get serious, and it's going to get serious in a hurry, right? The other major indicator in here, and I look at a lot of stuff, but the other major indication, if we start to get a little bit more serious in the S&Ps, I'm telling you, they're going to rally that dollar, okay? A dollar rally could be a sign of just devastating and imminent risk coming. And the dollar looks poised to me, all right, to make that break to the upside. I don't know if it's going back to 92, but it's poised to make the break to the upside. And again, I've mentioned this so many times, so many different videos. I'm like, what it kind of means to me when the dollar really starts to rally, all right, is our dollar, you think what you will about it. You're like, the dollar is garbage. I'm not disagreeing with you, okay? But our crap is better than their crap, right? Again, I'd rather be in the dollar than be in like the euro. Where am I going? Oh, I'm going to go over to the Chinese yuan because I really need to buy some yuans. And people are like, it's not going to be the reserve currency. Really? I'd like to hear what is, huh? Christine Lagarde is going to be running things over there, huh? Turned IMF into the ECB. Listen, forget about all that. They're going to run to the dollar. If it's coming down, everybody's going to want that dollar. If it starts to rally, prepare for impact. And at that point, it may be too late, but the dollar is a great confirmation tool. The bonds would be a great confirmation tool because if you buy bonds, they're dollar denominated. Think about that for a second. So you may see traders rush to the bonds, rush to the dollar. They're not there right now. And that's why I say, will the selling stop? Okay. Most of the time I come in here and I try to be a little bit more definitive with an opinion piece. Listen, I'm going to tell you right now, my real feelings on this, I'm going to tell you the real feeling in here, okay? And you may or may not like this. I think this marketplace is going to be extraordinarily diabolical, trying to rope more and more people in. We are going to come down to 360. We're going to rally. And then we're going to come down even deeper and we're going to rally hard. It's going to be rip your face off rallies. And every single time they come in there and try to buy the dip, this marketplace is going to take us slower. Okay? Marketplaces are diabolical like that. A straight drop, okay, to the downside followed by a rally. Listen, the rallies are going to come. There is still so much cash out there. But the one thing I want you to know, okay, is when you start seeing that sell side activity, that it is very likely not the buying opportunity that you thought it was. And if you're going to go out there and you're going to buy something, people, just use spreads. Like, mitigate your risk. Use like an in-out spread, a strike in the money, a strike out of the money. You get caught in the crossfire trying to buy some stock out there, you are on your own, people. Again, will the selling stop? Probably not. Probably not. But again, I'm going to be doing bounce and fade trades. I hope that, that sell side activity kind of continues. I love the volatility. Love it. Not to mention, okay, I mean, this just an incredible week. I'm out there now. In fact, I got the first time I got to sell some puts today. I was excited about the project, okay, but I actually started selling, again, a bit more premium, and this is a little bit of like onesie-twosie stuff over here, but when you start looking at it, again, I'm starting to build out a little bit more of an inventory, and this couldn't have been a better, cleaner trading week. Again, net damage was mild, but the volatility exploded, and when you've got like volatility positions laced throughout your portfolio, it's a good place to start. All right, now let's have a little bit of a candid discussion, okay? And I'm not going to try to. People may disagree with this. That's fine, okay? Listen, a little bit of when I say a candid discussion. First of all, I want you guys to understand one thing. I did spend 15 years in the brokerage world. I am no longer in the brokerage world, okay? In no way, shape, or form. Nobody's paying me to influence me about what to discuss in terms of GameStop or any of the other, okay, stocks that are involved in the big squeeze here. But I'm going to give you, all right, both sides of this equation. And I want you guys to understand it from the brokerage side of the business, the clearing side of the business, and us, the retail side of the business. Okay, so here's the candid discussion, for better, for worse. What is going on in GameStop? Okay, first of all, you got a bunch of monkeys in a chat room. Hey, I've been reading it too, so I'm one of the monkeys, all right? Got a bunch of monkeys in a chat room. They actually think that they're going to destroy these hedge fund managers. Let's start there for a second. What? Oh no, Steve Cohen. You know what? Even if you bankrupt his entire hedge fund, what's it going to do to him? I'm pretty sure he's going to be okay. He may have to downgrade from like flying, in that G5. He may have to only fly in like the Gulfstream 3. Instead of like being the wide body, he's going to be in like, the smaller aircraft that has the bathroom like, pretty much in the main, fuselage. Not good. Anyway, the point I'm trying to make is you ain't going to destroy anything. That's the first thing. The second thing, the bid offer spreads are so wide in here. Like as a retail client, like you do not stand a chance. And that's, this isn't like market makers taking advantage of you. Like, listen, nobody wants to make a market in this chaos. And it's just that. I mean, like $10 wide like spreads in here. You can't win inside of the option market in here because this is like going into a casino. And every time you walk into a casino, if you have like a $10 bid offer spread, you're paying $50-$60 to be able to walk in every single time you actually place a bet. They're like, oh, you're going to place a bet? Well, when you place the bet, you have to give me $50 just to be able to place the bet, which makes absolutely no sense. So it's just catastrophic in here with a 630%. Now, okay, this is where the talk is going to get kind of dirty. A lot of people don't like the fact that they've been restricted by brokerage firms. Well, when you were actually signing up for your brokerage firm, do you remember signing like a little margin thing and you go, no, I did a cash account. Okay, so you did a cash account. Oh, I have an IRA. Okay, that's fine. But when you actually signed up for it, do you remember? Okay, they actually have to sign stuff that says your broker-dealer has a fiduciary responsibility. That means if I'm actually working at the brokerage firm, I got to say, like, listen, is my client capable of handling this stuff? And I know a lot of people kind of feel like I should be allowed to do with my money, okay, whatever it is I want to do with my money. And I tend to agree with you. And I really, really do. Like, you should be able to do whatever you want and whatever it is you want to do with your money because it's your money. If you want to freaking lose your money, you should be able to lose your money. But in this case, you have no chance. You have no chance. Most people that are going to trade in here, and I know that everybody's looking at, online in a Reddit chat room, and this guy made $2 million in here. Yeah. The only problem with that is it sacrificed another million people for that one guy to be able to make the $2 million. People are getting destroyed in here. Okay, listen, I have actually spoken, to several people at a brokerage firm. And first of all, I want you to know this. There's not regulators. The regulators are definitely going to get involved here if the broker-dealers don't do something. See, the broker-dealers, and people think, oh, the Securities Exchange Commission. Listen, the Securities Exchange Commission, they got a new sheriff in town. Like, don't you think they want to make an example? This is like, listen, every good crisis, you just can't let it go to waste, right? So they got a new sheriff in town over at the SEC. Of course, they're going to step in and they're going to do something over here. But the broker-dealers, they're making decisions autonomously. They're not talking. Okay, they're not talking to anybody but the clearing firm about possibly risk. You think they're actually talking to like the hedge funds? These people do not like each other. Okay, the brokerage firm and like a Citadel out there, the two of them, yeah, there's some symbiotic relationship. But again, okay, they very, very infrequently will have discussions about anything regarding positions like this because, quite frankly, the brokerage firm doesn't give a crap what Citadel's doing. They don't care. Okay, Citadel also, and when I mention Citadel, that is a giant internalization engine that fills the other side of your orders. Citadel is rooting for the retail client, and people don't get that crap, and it kills me. They are rooting for you, and be like, those are evil hedge funds because the CEO of Citadel, what did he do? He bought like, a couple $100 million apartment in New York, by the way. He also bought that few $100 million place in New York at the absolute peak of the marketplace right before a pandemic. Great trade there, buddy. Anyway, the point that I'm trying to make with this, the only thing that Citadel makes, okay, they're not in this long or short. They're not. They just make the bid offer spread and they just scalp stock against it. By the way, they're allowed to short stock in here. They can short all the stock they want. Okay, so why? Because they're bona fide hedging activity. It's a market maker. They can buy and sell stock, and it's nothing. And again, there's so many misnomers about what's going on in here, and it's just ridiculous. It's not you against the hedge funds. These hedge funds are pulling for you because if you continue to trade, they're going to make money in the bid offer spread, and you need to understand that. So when the brokerage firms though start to restrict you, okay, I'm just going to give you my take on this. I actually don't mind that, and I'll tell you why I don't mind that. For 15 years, okay, I went through a lot of brokerage firm arbitrations, meaning that a client came in and they say, and here's the favorite one, client came in and they say, you let me trade the VXX. Okay, I've been to arbitration a multitude of times over volatility and volatility related products. It's like one of my specialties, right? So I go to arbitration in here and talk about the VXX. You let me trade the VXX. You bad man. You bad man. What do you think they're going to do, okay, with GME? Like, seriously. You think people are not going to sue the brokerage firm? Be like, how could you possibly have let me trade the GME? You made me sign a form that's saying that I have a fiduciary responsibility, and meaning the brokerage firm is a fiduciary responsibility. How could they not restrict you on stuff like this? Because those that understand risk management know that a 600% implied volatility means death to retail clients. It just does. And I get it. It's David versus Goliath, except that Goliath, really, the brokerage firms that everybody's like, those bastards. Listen, I worked there, and I'm going to tell you right now, I ran education for TD Ameritrade from like 2010 to 2015, and I will tell you firsthand that every single person I worked with there, every single person had your interest, okay, put first. Period. No if, and, or but about it. I can't say that because I haven't been there for the last 5 years, but I can tell you in restricting you, okay, they're doing you a favor. Because you're going to get ripped apart in the bid offer spreads. And sure, Citadel does make a crap load of money in there. And I don't want you guys to take that the wrong way. I really don't. But I'm going to tell you right now, nothing good is going to come out of people trading this. The last portion of it is simple. Okay? And a really candid discussion. You have to be careful that GME, okay, costs and others, this could actually spill over, okay, in a domino effect. It's actually what we call, there's systematic risk and then there's systemic risk. And what you could actually have in effect, if like something like GME shot, for instance, to 1,000 or 1,200, okay, it's not going to destroy just a hedge fund. The hedge fund, whatever, okay? So what if they get destroyed, right? Who does that hedge fund clear through? Who does the hedge fund clear through? I don't know. A lot of people don't remember like a company called Bear Stearns. And I'm not talking Bear Stearns because they got destroyed back in 2008. Bear Stearns, like Long-Term Capital Management. Long-Term Capital Management was a hedge fund. Hedge fund actually blew up. And that hedge fund, had they actually completely blown up, they would have actually taken down Bear Stearns. The marketplace would have stopped trading. These hedge funds are leveraged, okay? And there's a point unto which that could actually have beyond systematic risk and go to systemic risk in the entire marketplace. So that's when the regulators are going to step in. And if the regulators step in, I'm telling you right now, if the regulators step in on something like GME or COS or other ones, and they could do it this weekend, if they step in, they're going to halt trading and everybody's screwed. And that's the point that I want to make over here. This could take down, it's every retail customer is going to get smoked because they're just going to stop it. And right. And then everybody's going to like, oh, come on. The regulators, they got the back of the hedge funds. It's not about the back of the hedge funds. It's about pure chaos in here. Once again, I'm going to remind everybody, it's $132 expected move coming next week in the SPX. Clean up your risk. It's the exact same thing I ended with last week. Clean up your risk. Don't be offended by anything I said in GME, okay? I'm just telling you like it is after 15 years in the brokerage business. I've been out of it for 5 years. But again, I actually managed risk both at a portfolio level for a very successful trading firm. I also went on to manage risk, okay, at both Thinkorswim and TD Ameritrade. Risk is everywhere right now inside of the marketplace. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.